If Tesla's volatility is making you lose sleep, you're not weak. You're just using the wrong ruler. Let me show you the two rulers the market is using right now. Hey everyone, welcome back. I'm Lynn. If you like calm, data first breakdowns of scary market moves, hit subscribe and tap like. It tells the algorithm you want research, not drama. All right, let's talk Tesla. Because lately, Tesla's stock has been doing that thing where you refresh your account, the number drops, and suddenly you're a doctor diagnosing your own stress symptoms at 2 a.m. If that's you, don't slam the sell button yet and don't rage close the video either. I'm going to say something blunt. A lot of what you're feeling isn't because you're bad at investing. It's because the market is running a smoke machine. And the smoke works best when you don't realize there are two totally different debates happening at the same time. Here's what made this week so interesting. On one side, you've got big name banks and analysts turning cautious, price targets getting trimmed, neutral turning into may, and the word risk popping up everywhere. On the other side, Cathie Wood and ARK are still leaning in, adding Tesla exposure while the crowd is nervously backing away. So, what's going on? Is Cathie a genius and Wall Street is missing the future? Or is Cathie early again and retail investors are about to get used as emotional liquidity? The answer is both sides can sound smart because they're using different measuring tapes. That's the core truth. Wall Street is often valuing Tesla like a traditional automaker. They focus on deliveries, margins, pricing pressure, and near term cash flow. And if you stay inside that frame, a lot of bearish notes feel reasonable. But Cathie Wood and most of Tesla's long term bulls are not using the automaker frame. They're valuing Tesla like a platform that could reshape transportation, energy, and AI enabled automation. Same company, two rulers, two totally different fair values. This is the exact kind of mistake people made with Apple in the early iPhone era. Back then, plenty of smart commentary looked at the iPhone through the lens of old phones. Hardware margins, carrier power, Nokia and Motorola dominance, and said, this won't change the industry. But Apple wasn't selling a phone. It was selling an ecosystem entry point. The minute you measured it as an ecosystem, the story changed. Tesla bulls argue the same thing today. If you measure Tesla as cars sold times auto margin, you get one answer. If you measure Tesla as an autonomy network, plus robotics, plus energy infrastructure, you get a completely different answer. So let's step into that second ruler for a moment. What is the bull case that makes people buy more when the stock drops? In my view, Tesla's long term story is basically three big cards. And yes, they're high risk, high upside cards. Card one, Cybercab, and the robotaxi network effect. You've probably seen the Cybercab concept, a purpose built robotaxi with no steering wheel and no pedals. That's not a design flex, that's a business model statement. It's not a car you drive, it's an asset that runs 24/7 and collects cash. Tesla has said Cybercab production is on track, and reporting has described the vehicle as designed without a steering wheel or pedals, exactly because the goal is full autonomy. Now, in Tesla's most bullish narrative, the really scary part is not one Cybercab. It's the network. Tesla now has a global fleet counted in the millions of vehicles, and Tesla China has publicly celebrated over 9 million owners worldwide. Bulls look at that and think, those aren't just cars, those are potential robo-taxi nodes. Like iPhones were not just phones, they were future ecosystem users. And if you believe Tesla can get to truly unsupervised full self-driving approvals, then your fleet turns into a distributed income network. Owners can rent out the car, Tesla takes a cut, and suddenly you're not looking at a car company, you're looking at something closer to Uber plus a platform fee scaled across millions of rolling devices. That's why you'll hear Cathie Wood say robo-taxes drive a huge portion of Tesla's value. And that's why you'll hear wildly different price targets in the same year. For 2026 coverage, the high-end target is around $600, while one prominent bear target sits around $25.28. That's not normal. That's what happens when the market can't agree which ruler is real. Card 2, Optimus, humanoid robotics, and labor economics. Elon Musk has said Optimus could become infinite money. That sounds like Elon being Elon, but the underlying economic argument is serious. Human labor is expensive. Humans need sleep, training, safety, healthcare, wages, and they can quit. Robots can work around the clock if they don't ask for raises. And if production scales, unit costs can fall. The bullish version of this story is labor cost trends towards zero. Now, are we there today? No. But Tesla keeps pushing the timeline. Recent reporting quotes Musk saying Optimus production volume won't be significant until the end of 2026. And he has described early ramps as agonizingly slow before accelerating. In bullish Tesla land, that's still enough because the payoff is massive if it works. Card 3, the energy business that almost always gets ignored. This is the part I think even many Tesla bulls underweight emotionally. Tesla's energy generation and storage segment has been a bright spot. For example, Reuters reported the energy segment hit record quarterly revenue of $3.84 billion in Q4, up 25.5% year over year. That matters for one big reason. In an AI era, energy is not a side quest. Energy is the foundation. Compute drives AI. AI drives autonomy and robotics. Robotics drives manufacturing scale. And energy storage supports the grid stress created by all of it. Even Tesla's own ecosystem shows this looping back, especially as Musk's companies expand AI infrastructure and data centers. So when bulls describe Tesla as a tech empire, this is the loop they mean. Now let's do the part nobody likes. Even if the long-term story is plausible, retail investors still get wrecked all the time. Why? Because they copy the story, but they don't copy the execution. Cathie Wood is not a buy once, never touch it character. She trades, she rebalances. A concrete example. ARK's disclosed trade activity shows ARK sold 86,139 Tesla shares on January 14th, 2026, while Tesla still remained a top holding in ARKK at roughly around a 10% weight. Then, in early February, ARKX opened a new Tesla position with 35,766 shares. So Cathie isn't diamond hands forever. She's more like take risk, manage exposure, and be tactical with entries and trims. And here's the harsh truth. Cathie can do things most retail investors can't. She's managing long duration capital with a structure designed to tolerate volatility. Most individuals are not. And if you're using money you might need, or worse, if you're using leverage, then a 30% drawdown isn't volatility. It's a forced decision. So you can be right on the thesis and still lose because you can't survive the path. That's why I always say, in markets, execution is the product. Now let me give you the reality check section. The 3 variables that can absolutely decide whether Tesla's story gets paid or gets postponed. First variable, Musk bandwidth. Tesla is not just a technology bet, it's partly a Musk execution bet. And Musk's attention has been spread across Tesla, X, SpaceX, XAI, and even his high-profile involvement in Washington's Department of Government Efficiency, or DOGE. If the Cybercab timeline slips again, or Optimus ramps slower than promised, the empire valuation can compress fast. Second variable, regulation. Regulation is the mountain you can't brute force with hype. This is not theoretical. California's DMV has pressured Tesla over marketing terms like autopilot and full self-driving, and Tesla took corrective action to avoid suspension. And Reuters also reported Tesla logged 0 autonomous test miles in California in 2025 and took no regulatory steps toward robotaxi permits there, while Waymo has accumulated far more testing miles and approvals. You can build the tech, but you cannot speedrun licensing. That's not how government works. Third variable, competition, especially from Waymo. Even if you believe Tesla's approach wins long-term, time matters. Waymo has years of operational learning, regulatory positioning, and consumer habit formation in specific markets. Some estimates floating around claim Waymo is already earning roughly $7 to $8 million per week. Waymo doesn't publish that figure, so treat it as an estimate, not a confirmed number. But the strategic point is still real. The first company to safely monetize autonomy at scale gets a head start that isn't just technical. It's brand, it's trust, it's user behavior. Now, after all that, what do you actually do with your Tesla position? Here are 3 practical rules you can use immediately. Rule 1, know which story you're buying. Tesla's price includes 2 things, the car business and the future platform option value. When Wall Street price targets range from $600 down to around $25, that's the market admitting it has no consensus about which story is dominant. So ask yourself honestly, are you buying car profits? Or are you buying a long dated bet on robotaxis, robotics, and energy? If you don't know, you're not investing, you're renting a mood. Rule 2: use my 3-question crash test before you panic sell or panic buy. Question 1: did the core thesis break? Did Tesla cancel robotaxi? Did Optimus get shelved? Did the autonomy approach get proven unworkable? If those answers are no, the price might be falling, but the story might still be intact. Question 2: did the hard data materially turn? Watch what's measurable: delivery trends, energy deployments and growth, and whatever proxy you can track for software take rate, including FSD related adoption signals. If the hard data is stabilizing or improving, a dip might be emotion, not fundamentals. Question 3: are you afraid of the company or are you afraid of your screen? If the company didn't suddenly break, but your sleep did, your position size is the real problem. Rule 3: position structure beats perfect timing. Cathie can buy dips because her capital structure can survive the dips. You should not copy her buys unless your money can truly sit for years. No emergency fund, no rent money, no mortgage payments, and please, no leverage. Institutions don't bet their life. They bet probabilities and pacing. If you go all in, you're not more confident, you're just more fragile. All right, if this video helped you feel calmer and think clearer, hit like and subscribe. I'm Lynn. See you in the next one.